All right, let's dive in. Today, we're going to crack open the doors to one of the most powerful, yet least understood institutions on the entire planet, the U.S. Federal Reserve. So, let me ask you this. What's the one institution that has a huge say in your financial life, but for most of us, well, we don't really get how it works? Well, there's a good chance it's the one that basically controls the cost of almost everything you buy. Yep, we are talking about the Federal Reserve, the Fed. And today, we're going to pull back the curtain and figure out how this whole machine really works. Okay, so to really get why the Fed even exists, we've got to jump in a time machine. We're heading back to a period that was, honestly, a financial Wild West. Before 1913, things were chaotic. The whole American banking system was just so unstable. You had no central authority, nobody to step in during a crisis, nobody to stop a bank run. I mean, even something as predictable as farmers needing cash for the harvest could throw the whole system into a tailspin. It was constantly teetering on the edge of collapse. And just look at how often these crises happened. We're talking about a major panic every decade or so. The system would just break. The absolute final straw was the Panic of 1907. It got so bad that one guy, a private banker, J.P. Morgan, literally had to step in and organize a bailout himself. That's when Congress basically said, okay, we can't have the fate of the entire economy resting on one rich dude's shoulders. So out of all that chaos, an idea started to form. A blueprint for a totally new kind of economic machine, one that was built to bring some much-needed order and stability. And that brings us to 1913, when President Woodrow Wilson signed the Federal Reserve Act into law. The core idea was simple, but honestly, it was revolutionary for its time. The goal? Prevent those panics we just talked about. The Fed would be what's called a lender of last resort. Basically, it could provide emergency cash to banks to stop them from going under during a crisis. And this mission statement says it all, right? To provide the nation with a safer, more flexible, and more stable monetary and financial system. It wasn't about power for the sake of power. It was about building a safety net for the entire U.S. economy. Okay, so we've got this new institution, but who's actually running the show? The way it's set up is pretty unique, actually. It's this hybrid system that tries to balance being accountable to the public with understanding what's happening in different parts of the country. So up at the top, based in Washington, D.C., you have the Board of Governors. That's 7 people, including the famous Fed chair. They're all appointed by the president and confirmed by the Senate. This is the public-facing, government-accountable piece of the puzzle. But here's the clever part. To stop all the power from being stuck in Washington or on Wall Street, they divided the country into 12 districts. Each one has its own Federal Reserve Bank. And this is so important because it makes sure that the economic reality of, say, farmers in Kansas City or the Texian in San Francisco actually gets a voice at the table. Now, that whole structure is important, don't get me wrong, but the real power, the place where the big decisions get made, the ones that move markets and, affect your wallet, that all happens in one specific committee. And that committee is the FOMC, the Federal Open Market Committee. Let's break down who's in it. You've got the 7 governors from the main board. Then you have the president of the New York Fed. They get a permanent vote, which kind of shows you how important Wall Street is to all this. And then you have 4 other presidents from the regional banks, and they rotate in and out each year. These 12 people, they are the ones who set monetary policy for the entire United States. All right, so we know who they are, but what do they actually do when they meet, which is about 8 times a year? Well, they pull the master levers that steer the whole American economy. See, Congress gave them a job to do, and it has 2 parts. It's called the dual mandate. Goal number 1, maximum employment. Basically, make sure as many people who want a job can get one. Goal number 2, stable prices. In other words, keep inflation low and steady, right around a 2% target. And trust me, trying to do both at the same time is a huge balancing act. So how do they pull off this balancing act? Well, their main tool, their number 1 weapon, is something called the federal funds rate. I know, it sounds super technical, but stick with me. All it is the interest rate that banks charge each other for super short-term, overnight loans. But that one little rate, it's the master lever that ends up influencing pretty much every other interest rate you can think of. And this is how that ripple effect works. The FOMC gets together and votes to raise or lower that key rate. Right away, that changes how much it costs for banks to borrow money from each other. And what do?
they pass that cost or that savings on to us. That's why your mortgage rate, your car loan, and your credit card interest rates all move up or down. It all starts with that one decision.
Now, when things get really crazy, like during the 2008 financial crisis or in 2020, the Fed has to break out the big guns. You've probably heard of quantitative easing, or QE. Think of that as slamming the gas pedal on the economy. The Fed starts buying up a ton of bonds to pump cash directly into the system and push interest rates way down. The opposite of that is quantitative tightening, or QT. That's like tapping the brakes. The Fed starts to shrink its bond holdings, which pulls money out of the system to help cool things down when the economy's running too hot. Okay, let's bring this all back to you. We've gone through the history, the structure, the tools, but why does any of this actually matter to you? The answer is simple. Because every single major decision the Fed makes directly hits your wallet.
No, seriously. Think about it. The Fed raises rates. Suddenly, the monthly payment on that dream house you were looking at gets more expensive. But on the flip side, that high-yield savings account you have might finally start earning you some real interest. Or maybe they lower rates. That might be just what a local business needed to feel confident enough to expand and hire more people, maybe even you. Your loans, your job prospects, your savings, it's all connected to the decisions made in those meetings.
And its reach is even bigger than that. The Fed's actions can send the stock market soaring or sinking. They are the primary force fighting or sometimes even stimulating inflation. And honestly, they play a huge role in keeping the entire global financial system stable. So yeah, when you put all the pieces together, the conclusion is pretty clear. From the interest rate on your credit card to the value of your 401k, the Federal Reserve is, without a doubt, the most powerful economic institution in the United States.
And that leaves us with one last really big question to chew on. This institution holds an incredible amount of power, and it's intentionally designed to be separate from the daily grind of politics. So is that independence a good thing, a necessary shield that lets them make tough calls for the long run? Or is it just too much power in the hands of a few without enough accountability to the public? Something to think about.